Welcome to another edition of Strategic Financial Management. In today's class, we shall be looking at new topic, right? That is different from what we've been doing from the beginning of this lecture, and which is you can hear me. Please confirm if you can hear me. Ah, please, someone should
Can
confirm. Can you hear me?
yes, sir.
Yes, you have to. Yes, you have to log in. Yes. Okay. In today's class, we'll be looking at a new topic, which is either financial plan or you say cash planning. Class, what is this all about? The cash planning or a financial planning is all about you are planning to achieve a certain objective, right? There's no notes. It's just like you work in an organization and you need to make a plan for 2026. By doing that, you have to forecast. You have to forecast what will be the profit in 2026. That is what we call cash planning. That is what we call planning. You have to plan ahead of that period, right? And that is what we call cash planning or financial planning. Okay, right? Now, class, in financial planning or cash planning, right? You need to do a forecast for three things. What are the things? One, um, profit, profit or loss accounts. Two, statements of financial position. Three, cash flow statements. So these are the three things you need to forecast for when you are doing a financial planning in an organization. I will assume that you work with AA Nigeria Limited, right? And you need to give them the financial plan that what will be their profit at the end of 2026. You are planning, right, to achieve a certain objective. Your objective could be that the profit for last year was 250 million, for instance. And you say, oh, 250 million. Okay, the profit will increase by this. Okay, you want to achieve a profit of 350 million, right? You have an objective, class. Now, in this case, now, for you to achieve that profit of 350 million, what will happen, class? You need to start from your revenue. You say, oh, you could, based on the previous experience. No, it's your network. Please confirm. Can you see my screen? Please confirm. Can you see my screen? Okay,
Yes,
it's your
sir.
network. Okay, it's your network, please. So, what I'm saying is that when you are making a forecast or when you are making a plan, of course, you need some variables. For instance, your revenue, right? When you want to do profit or loss account, you start from your revenue, cost of sales or direct expenses, depends on the company, right? Depends on what? Depends on the company. Now, when you want to start from revenue, for instance, you could say, oh, the revenue of last year was 56. Oh, next year it will increase by 2% or 5%. That is a plan, that is a forecast. Even if it is you are planning it that, oh, the revenue will increase by 10%. The same thing applicable to your cost of sales. And these are the plannings you are trying to put in place in 2026. That is what we call cash plan or financial planning, right? You forecast for the profit or loss. You make a forecast for the statement of financial position. Don't forget, when you are making a forecast for profit or loss, what did you want to achieve? You want to achieve your profit. You want to know what you will have at the end of the period. Then when you are forecasting for the statement of financial position, what is the objective? The objective is to say that, oh, will you have a cash balance at the end of the period, or you have an overdraft? That is the objective. The objective of you doing a forecast cash flow statement is for you to determine that, oh, will you have a cash deficit? Will your cash be deficit or the surplus at the end of the period, right? And that is the objective of all this planning, right? And we will look at the question where the question will tell us that we should forecast for profit or loss, the statement for of financial position, and the cash flow. Now, most people will ignore this financial planning. Do you know why? They will tell you that it's very simple. Go and check. When you look at the adjustments, you will know that yes, you have to practice it. It is very important. I think it came out one diet like that recently, right? So that is why we have to treat this question. Just have two questions there, right? Then you do number one question and I will do number two question. Class, before we proceed, before we go to the calculation, straight to calculation, I hope you will be able to understand my point in the financial plan or forecast. Class, are we good? Now, if all this
Hello,
is
sir.
you are just joining us now. You just join us now. Aishat,
Sir, good evening, sir.
you just join us now. So you know it as we move on. So this is what we want to forecast for, right? Don't forget, you forecast for three things. You work in an organization, you make a forecast for profit or loss, the forecast for the statement of financial position. What is the objective of the you making a forecast? Is for you to determine what to achieve a stated objective. The objective could be that you want to achieve a profit after tax of 250% or 50 million. That is the objective. Do you actually achieve the objective? Why do you have to do a forecast statement of financial position? It's for you to determine if you will have a cash balance, of which we'll get there, cash balance or an overdraft at the end of the period. Why do you want to do a forecast for a cash flow? You want to use it to determine if the organization will have a cash deficit or surplus at the end of the period. And that is the purpose or the objective of you doing a forecast, right? For those of you who do financial modeling, your input is an assumption. From your input to your profit or loss, from your profit or loss to your cash flow, from your balance sheet to where to cash flow statement, you use an assumption. Is that also what did you want to achieve? You want to achieve a stated objective. What is that? That one will take us to valuation of a business, right? So now, and these are the things that we want to do today: the forecast profit or loss, the forecast statement of financial position, as well as the forecast what cash flow. I've equally stated the objective, right? So as we proceed, as we look at this question, we will understand better. Now, illustration one. I have two questions here. The two questions is adopted from ACCA and as well as ICANN question, right? Please don't joke with all these questions. Most particularly my questions, they are very important. I'm not a prophet, but when I give you something to do, please ensure you do it. Please, it's very important. Now, we'll look at question two. I will do question two, you do question one. Yes, let's do it like that. Yes, this is question 1. Then you do question 1, I do question 2. Right. I think question 1 is past question. I don't know. But I know is somehow you will see it in past question, sure. So question 2, quickly. First, what is the required? We need to look at the required first. The required is very important. Required. A. Prepare forecast financial statements comprising income statements, balance sheets, and cash flow statements. You can see the combination for each of the years ending 31st March 2022 and 2023. Class, this is 20 marks, 21 marks. This is what? This is 21 marks. All calculations should be undertaken to the nearest thousands. B. Looking beyond, we'll look at all these ones later. Let's deal with, okay, let me just read it. Looking beyond 31st March 2023, the directors are considering a suggestion made by the finance director that one of Kola smaller Nigeria subsidiary be disposed of because relative to most of the other Nigerian operations, it is trading poorly, right? And it's still profitable, right? At the same time, still profitable, right? Now, why the directors are broadly supportive of the finance director's what suggestion, because it is trading broadly and they have believed that it can still be profitable, but the directors are broadly supportive of the finance director's suggestion that they should sell it off. They are keen to avoid the liquidation of the subsidiary as they are acutely conscious of the industrial relations problem that might arise from the redundancy that would inevitably be involved. Required. Describe 4 methods other than liquidation that the firm might consider to affect what? Divestment. The question is, what is divestment? We'll get there. Assuming that the same firm of accountants act for both caller and potential purchaser of the Nigerian subsidiary, explain how any conflict of interest could be managed. 4 marks. Total marks 30 marks. Now, the first required class is to do what? The first required is to forecast the income statement. Class, are we still together? The first required is to do what? Is to forecast the income statement. You do a forecast for the balance sheet and you still do a forecast for cash flow statement for each year, which is 31st March 2022 and 2023. Class, are we still together?
Yes, sir.
Okay. Now, we move to the main question, right? So, we move to the main question. You can see the question. When you see it in a it's like a two pages, right? Now, Kola is a supplier of specialist engineering. Kola is a supplier of specialist engineering components to the defense and airline industries. In spite of the impacts of the global recession, demand for the company's products has held up well in recent times and is expected to pick up further in the next 2 years. As part of a recent strategic review, the directors have made the following projections for the years ending 31st March 2022 and 31st March 2023. Now we want to analyze the projection. Class, we want to do what? We want to analyze the projections. Now, what are the projections? One, when you want to prepare a forecast for profit or loss, you will start from your revenue, either cost of sales or direct expenses or anything given to you in the question, right? Now, we want to start the what? The projection. An anticipated increase in annual revenue of 8% per annum in each of the years. So, which means that the revenue will increase by how many percent, class? Will increase by how many percent, class? 8%, right? Now, let's check from our financials. Of course, when you want to do a forecast, you will already have a financial information given to you, which is the income statement as well as the financial statements. Then this is you work in an organization that your revenue for last year, that is what you will use to determine your revenue of this year by increasing it, all right? By increasing it with what? With a certain percentage, maybe 2% or 8%. Now, in this question now, the question says that the revenue, which the revenue of 2021 will now increase by what? 8% per annum. Per what? Per annum. Now we move again. An anticipated increase in operating costs, excluding depreciation of 4% in each of the years. So which means that the operating cost will increase by 4% in each of the year, excluding depreciation. Now let's quickly go back. Excluding what? Depreciation, which means that our operating cost must not include depreciation. That is, when we want to increase the operating cost by 4%, it must exclude depreciation. But it was not even stated that whether the operating cost include depreciation or not. But they say it exclude depreciation. Now, we move again. The directors are assuming that for the next 2 years, tax will continue to be paid at a rate of 17% and be payable in the year in which the liability arises. Now, this is what? This is the tax. The tax will be paid in the year in which the liability what? Arises. So this it means that when you make a profit this year, the profit will be subject to tax in that particular year, not that it will be in arrears. That is what it means. That is the projection. Another one is 4. The ratio of trade receivable to revenue will remain the same in each of the next 2 years. Class, the ratio of the trade receivable to revenue will remain the same in each of the next 2 years. Class, don't forget that the question says that we should prepare, you have the question that we should prepare the financials for 2 years, 2022 and 2023, right? And you were given 2 financials, which is the income statement, which is this, the income statement, as well as what? The statement of financial position. Now, the Roma figure 4 is saying that the trade receivable will do what? The trade receivable, the ratio of trade receivable to revenue will remain the same in each of the next 2 years. Let's analyze this now. So, what is the ratio of the revenue? Now, they said the revenue should increase by how many percent? 8%. So, what it means is that your receivable will also increase by how many percent? Will also increase by 8, what? By 8%. That is what it means. The ratio of trade receivable to what? To revenue will remain the same in each of the next 2 years. Class, it means that the ratio you use for your revenue will still be the same ratio you will use for your what? For your trade receivable, which means that your trade receivable will increase by how many percent? By 8%, because your revenue increases by what? By 8%, according to this question. Now, as well, the ratio of trade payables to operating costs exclude depreciation. Class, this is another point. You can see when you look at it, you look at, oh, forecast is simple, right? But look at the clause here. The first one is the ratio of trade receivable to revenue, which means that your percentage of your revenue will be equals to the percentage you will use for your trade receivable, which means that if the revenue is increasing by 8% in a year, your trade receivable will also increase by that what? By that percentage. While your trade payable, right? While your trade payables to operating what? Cost, which means that your trade payable will also increase on the basis of what? Operating cost, the ratio of trade payable to operating cost. Now, in this question now, we were told that operating cost is how many percent? 4%, which means that your trade payable will increase by how many percent? By 4%. And that is what it is. Class, are we still together? Class, are we still together?
Yes, sir.
Hello? Okay, okay, that's fine. Now, if that is established, the next one is an anticipated increase. An anticipated increase in inventory levels. You can see the forecast. These are the projection they are talking about, right? At the beginning. Now, anticipated increase in inventory levels of 10% in the year ending 31st March 2022, but remaining stable thereafter. So, which means that the figure for the inventory for 2021 will increase by 10% in 2022 and it will remain the same in 2023. Class, you have an inventory of 2024 of 2023 and you say, oh, your inventory increased by 10%, which means you are using the previous information to forecast the future, right? That is what it means. Woman figure says the non-current assets in the company, we need to analyze it, all right, the numbers by numbers so that you will actually have an understanding of it, right? The non-current assets in the company balance sheet, Akola's headquarter accounting policy is that these assets are not depreciated. Capital allowance on these assets are negligible and can be what? Can be ignored. Now, the non-current assets in the company balance sheet, Akola's headquarter accounting policy. What is the accounting policy? The accounting policy is that the non-current assets of the Collar's headquarter are not depreciable, right? Now let's quickly check the non-current assets in the statement of financial position. Can you see it? So which means that this non-current asset is not depreciable, which means that you will carry the same amount in 2022 as well as 2023 because it is what? It is non-depreciable. That is the company accounting policy. Now, if that is established, right? If that is what? Established, we move to Roman figure 7. Please, if you don't understand the analysis, so let me know. The Roman figure 7. The directors foreseen no change in the company annual dividend growth of 6% per annum. Annual dividends are declared at the year end and paid in full during the following financial year. Class, it is possible for a company to declare a dividend. You can declare a dividend this year, right? But you did not pay it and you paid it in full in the following year. What it means is that, class, it is logical. AA Limited declared dividend of 50 naira this year, declared but not yet paid at the year end. That amount that was declared will be treated as a liability in the balance sheet, in the statement of financial position. Now let's check. Let's check the dividend of the company. Let's check. You will see what I'm saying. Let's check. Where is it? Can you see it? You can see the dividend. This is for the dividend of 2021. You can see, why is it under liability? It is because that the dividend was declared that year, it wasn't paid. It will be treated as a liability, right? They are owing the investor. You only declared it, but not yet paid. But in 2022, because the question says they will be paid in full in the following year, which is Roman figure 7. So it will be declared in 2021 and paid in 2022. The one that you declared in 2022 will be paid in 2021. Class, do we understand the analysis of Roman figure 7? Do we get that? Class, do we get the analysis of Roman figure 7?
Yes, sir.
Yes, sir.
Okay, that's fine. We are all professionals. I know we'll get all these ones. So, next, Roman figure 8. To cope with the anticipated come Roman. To cope with the anticipated increase in business levels, Kola will shortly be purchasing new machinery at cost, right? Which means that Kola will purchase new machinery, they will have a new machinery at cost, right? The new machinery at cost. All existing, come, sorry. All existing machinery is rented and its rental costs are included in operating costs. The rental costs are included in your operating costs. Don't forget, Kola purchased new machinery at 8 million. The company is not intending to seek any equity or long-term debt financing. The company, class, the company is not what? The company is not intending to seek any equity or long-term debt financing in respect of this machinery purchase. Now, as it intends to accommodate the purchase within existing overdrafts, which means that they want to buy this, they purchase this, what is it called, this machinery using their overdraft facility available to the company. Now, the new machine will be depreciated. You can see the new machine that was bought recently will be what? Will be depreciated, right? Will be depreciated on a what? On a straight line basis over what? Over 8 years. And assuming a residual value of 1 million. Do we still remember the way we normally do depreciation? That we say, oh, when it is straight line, we say cost minus residual value divided by the numbers of years. We give you your depreciation for each of the year. That is straight line method. With a full year's depreciation to be charged in the year the machinery is purchased, right? Which means that the assets, you charge depreciation at the end of the year, right? You purchase assets in January, at the end of the year, you charge depreciation on that what? On that what? On that asset. Now, capital allowance on a reducing balance, on a reducing balance basis at the rate of 18% per annum will be available on the new machine from the year of acquisition. Class, you are charging a depreciation and at the same time, there will be a capital allowance, right? There will be a capital what? Capital allowance on that. You know, depreciation, you don't allow depreciation in tax for the purpose of tax purpose now, because the question now mentioned capital allowance. For the purpose of the tax now, you can't charge, for instance now, you have your profit after tax. You can't charge your profit before tax. You can't charge tax on it. Do you know why? Because That your profit before tax is inclusive of what? Depreciation. And since the question mentioned capital allowance, so we have to adjust for that, right? We have to adjust for that. It's very simple. As a result of this machine purchase, there will be an anticipated increase in costs of 50% in the year. As a result of this machinery purchase, there will be an anticipated increase in finance costs. So which means that their finance costs will increase. Let's see in the question, let's see the finance cost. Oh, they give us finance cost of 800 in 2021. Don't forget, when you want to do a forecast, you must have an already made financial statement. You must have it so that you will be using that financial statement to forecast for the future. Is that not so? To forecast for the future, unless if you don't have any financials before, you have to start it from the scratch. That is where you start. If it is financial modeling, you start. You say some people say, "Oh, we do the financial modeling from the scratch." They don't have financials, right? Now, this is what 800, right? Which means that it will increase by 50% in the year 2020, 31st March 2022, but remain stable in the following year. Which means that because the question says that we should determine the income statement for 31st March 2022 and 2023. So which means that we will increase it by 50% in 2022, right? It will now remain stable in the following year, which means that it will remain stable. You don't need to increase it further. And that is the end of our analysis. You can see the income statement. After the income statement, you see the statement financial position, right? So distinguished professional colleagues, let's start the solution with forecast income statement. We'll start with forecast income statement for the 2 years. When we are done with that, we'll do the forecast balance sheet. We'll do the forecast cash flow statement. Then we'll move to B. Class, are we still together? Are we still together? What is the name of this company? Class, are we still
Yes,
together?
Yes, sir.
Okay. That is Color PLC. You have the material, you have the questions, right? You have the questions. Color PLC. Color suggested solution. Suggested solution. Suggested solution. Color PLC. Right? Forecast income statements for which months? For what? For 31st March, right? Class. Hello.
Yes, sir.
2022. Are you not with the question? And
Sir?
are you
Now
not with
with
the
you, sir.
question?
Hello, sir.
Hello, can you hear me?
Yes,
Are you
sir.
with the? I hope you are with the questions.
Yes, sir.
Okay. So forecast income statement for 31st March 2022 and 2023. So when you want to do that, you have to do your table. I'm coming. We must finish this question tonight, so please. That is why I needed to start. I need to start it the class early, so we can finish it March. Let me abbreviate 2022. Then 31st March 2023 class. So this is what we want to do, right? So we start from the revenue, right? We start from where? From the revenue, right? Just a minute. So I need to set the line. Revenue. So we're told that the revenue will increase by how many percent, class?
8%.
8%. Good. Okay, now let's check.
8%.
Okay, let's check. Is it in thousands? Okay, it's in thousand. Okay, it's in thousand. Okay. 8%. Um, right. So we can have this in thousands. Okay, 8%. That is 1.08 times. So what is the value for revenue from the financials? You can screenshot the financials or the income statements. What is the value? 6240, right?
Yes, sir.
6240. Are we tired? It's just two people that are just, I don't know, others are just sleeping. Are we sleeping?
I'm not sleeping though. No,
Okay. Everywhere
I'm not
is just
sleeping
dull.
though. But my screen
Ev-
is not showing. My screen is not
Oh,
showing.
it could be your network now. Change. Network is terrible bad today. Yeah, sorry.
It is very bad.
Yeah, sorry about that. So sorry about that. Just follow, okay? Just follow like that. If you are with the, okay, you can't see my screen. The network is actually bad. So, what you just do is that when you log in, you log out, you log in back again, and it still remains the same. You can just follow, right? Thank God you are with the questions and just follow like that, please. Please, just follow. Thank you. So, 6240. So, 6240. Since you are with the question, you give me figures, please. 6240. So what do you have? When you increase this one, what do you have?
65,059 naira.
65,000,
59 naira.
59 naira. I don't understand though. 59 naira. That
5,059. 5,000.
even your network, sir. I can't hear you. Like seriously. 65,059. Class. Okay. Okay, now I increase this one because we were not told that it will remain stable. We were told that it will increase per year. So increase 65,059 by
70,204.
17,200 and 200 and what?
64. 64.
Okay, 200 and okay, 264. In case you don't know how we got this, let me bring it out. So I will only do this one, then we do the remaining one, right? So multiply by 65,059. So you see how we calculate it, right? So based on the financials given to us, we have operating costs, right? We have what? Operating costs. Now, you can see that we were told in Roman figure 2, that an anticipated increase in operating costs exclude depreciation of 4% per annum in each of the years. And in any of this projection, it was not stated that the operational cost or operating costs include what? Depreciation. Is that not so? Include depreciation. Now, the question now is that when did they buy these assets? Let's check the year that they buy the assets. Okay, they said okay, which means that these assets, I'm coming, to cope with the anticipated increase in business levels, Collar will shortly be purchase new assets at a cost of this, and there is a depreciation. Is that not so? There is a what? There is a depreciation. The question now is that is the operating cost include the depreciation or not? the operating cost, is it include depreciation? Class, how many percent will you increase the operating cost? How many percent? 4%. Now, thank you. Now, don't forget that when you are doing your income statement, let me take you back to income statement, right? Profit or loss account, right? When you want to prepare it, depreciation can be added to the cost of sales or the operational costs or form part of the administrative expenses, depends on the company policy. Class, is that not so? Depends on what? Depends on the what? The organizational what? The organization policy, right? So now, in this case now, since they will purchase, they will buy, what is it called? They purchase the new assets, right? So where is the depreciation cost? Class, don't you think that the depreciation has been included in this 49,550? Class,
I think so also.
you say, hello?
I think they did so for them to state it that excluding depreciation when
Thank
we are
you.
increasing by 4%.
Thank you. That's good. So you can see that because the question says that exclude, and I have given an instance that in your financials, your cost of sales or your operating expenses, right, may include depreciation. Your cost of sales may include depreciation. It depends on the company accounting policies. Your administrative expenses may include what? Depreciation. Don't forget that, we don't want to put the way we normally do it in school, then where you separate everything, you have depreciation. No, you have to categorize the expenses by the function. Is that not so? You can classify expenses by function as well as by nature. Is that not so? Now, you have to classify it that way. So now, in this case now, the depreciation has been included in the operating cost. That is why they actually mention it that it excludes depreciation, which means that we have to remove the depreciation elements, right? The depreciation element from 49,000 from 49,000 from 49,000 500. But another thing is that if it has been included, it will be stated that this depreciation has been included in operating costs. And if it is stated that the depreciation has been included in operating costs, so which means that we have to remove it. But in this paragraph here, from note 1 to note 10 to note 9, it was not even stated that the depreciation is included in the operating cost class. So therefore, you will not consider it, because they just purchase the assets. That is one evidence. Another evidence is that if you are to remove it from the operating cost, it would have been stated that operating costs include depreciation. Then the next line would have been that, the operating costs include we increase by 4%, exclude what? Depreciation. Class, so please don't set question for yourself. In this case now, since it wasn't mentioned that the operating costs include depreciation, we will leave it like that. So we assume that the operating costs exclude depreciation, then we increase it by 4%. Class, are we still together?
Now, what are we going to do now? Are we going to remove the depreciation, or we are going to increase?
Now, the question, from this note 1 to note 9, is there anywhere that it is stated that your operating costs include depreciation? It wasn't stated.
No, sir.
It wasn't stated. So you just go on and say, oh, operating cost. You just increase it by 4% and you move on. Class, you move on. Because if they have included depreciation there, it would have been stated somewhere in the notes, from the projection. So class, operating costs. So quickly, let's increase it by how many percent? By 4%. 1.04 times. So what is the cost? What is the cost of operating cost? What is the operating cost?
49,500.
What do you have?
49,500. Total is
14,
51,000.
49 what?
500.
Thank you. So what do we have here?
51,480.
51,480. Next. So we increase this by the same amount. We increase it, but we were not told. Are we told that it remains stable? Because if they say it remains stable, which means we have to quote the same amount, right? So we're told that, okay, per annum in each of the 2 years, right? In each of the 2 years. So I'm coming. Per annum in each of the 2 years times 51,480. So please, what do you have here?
53,539.
53,539. Okay, someone, I think some new response from me. I'm coming. Let me check. Okay, Aishat, unmute your mic quickly. Aishat, unmute
All
your
right,
mic
sir.
for
So my
me.
question is that, yes, sir. So the question is that, pertaining to this depreciation, we are going to purchase an asset. So it wasn't stated the date or the year, and then we also told that a full year charge on that particular asset. So how are we going to go about depreciation? Since depreciation is also add like maybe to the operating was reasonable line item, maybe to so how are we going to deal with that
Depreciation.
factor?
In that depreciation, right? Aishat, depreciation, right? Hello, Aishat, can you hear me?
Yes, sir. Can you hear you now?
Okay, you were talking about
I
the
can hear you now,
depreciation,
sir.
right? Yeah, I can hear you. You were talking about the depreciation, right?
Yes, sir. For the new asset, sir.
For the new asset, don't worry, we'll
Exactly,
get
sir.
there. Yeah, we'll get there. We'll get there. Do you get? We'll get there.
Oh,
Yeah, thank you. So the next thing is
sir.
depreciation. Depreciation, right? The next is what? Depreciation, because they bought the asset what? New, right? So depreciation. Now, when you look at this, Seth, when you look at this from this statement, you will, for them not to include depreciation in the financials. So it could be that for them not to include depreciation in the financials in 2021, it could be that because they've already stated that the non-current asset that you see here is for the head office and it is not depreciable. That is the company accounting policy, right? Now, they now come to this that they bought new asset. This asset could be, they may even, it may be that they purchased this asset at the end of 2021, at the end, at which maybe when they've already closed their account, that is when they purchased this asset. Is that not so? For them not to even include it in your what? In your statement of financial position. So you cannot say, you cannot assume that depreciation is inclusive in operating costs. I just needed to call our attention to that particular side. Please pay attention to it. You can see that for them not to include depreciation here, it means that this asset was purchased at the end of, maybe at the end of the year itself, not when they are preparing this account, maybe after the financial year, right? After the financial year. And another thing is that it was stated that the depreciation that you see, the asset that you see here is for where? Is for the head office and it is not depreciable. So it's part of the reason why you did not see depreciation in this part, right? So we assume that the operating costs exclude what? Depreciation. Now, the next thing is depreciation. Of course, we need to factor in depreciation because they purchase new asset, right? Probably at the end of the financial year of 2021, right? And they purchase new asset, and this asset is depreciable. So depreciation. So we start with work one. Work one. So let's quickly do this workings. Depreciation. Okay. The straight line method. What is the formula? What is the formula? Costs
Cost
6
minus
minutes.
residual value
Thank you.
divided by number of units.
Thank you.
Sorry.
So cost minus residual value divided by the numbers of years, right? So we can have the cost of the asset is 8 million. We can use, since we are putting 1,000 here, we can put 8,000, or you use the 8 million minus the residual value is 1 million from the question divided by the numbers of years. Let me check. What is the numbers of years? Class, what is the numbers of years? You have the question with you, right? What is the numbers of years? Oh, the numbers of years is 8 years. Can you see it? The numbers of years is what? Is 8 years. So please, when it is 3 minutes to end this call, please let me know so I can create new link. We must complete this question today, please. It's very important. So divided by 8 years. So what is the depreciation amount, class? What is the depreciation amount? Class, what is the depreciation amount? Your network.
875,000 naira.
Okay, 875,000 naira. So 875 depreciation, 875 straight line, 875. That is the straight line method, right? Now, at them being now, in 2023, they purchased new assets, and the assets will be based on straight line as well. Is that not so? So what do? What will you do? You charge the depreciation on that asset because it is not reducing balance, it's straight line method. Is that not so? So what is the straight line method of the new asset? The cost minus the residual value, the numbers of years will give you the depreciation, the new depreciation. Is that not so? Don't forget that you have old asset before and you have old depreciation as well. When you add these two together, you have your total depreciation for 2023. Assume you were given another new asset or they purchased new asset in what? In 2023 class. Now, in this case, we move to, since we have to 6 minutes, 4 minutes. Okay, please let me quickly create another link so that we can complete this question. This is very important. We need to complete this question tonight. Thank you. I will create another link shortly. Thank you.